Friends, thank you for being here today. We stand at a precipice of financial history, a moment so singular and profound that it threatens to rewrite the rules of wealth preservation for generations to come. We are gathered here not to discuss a mere fluctuation in the stock market, nor to analyze the daily noise of political bickering. We are here to discuss a fundamental shift in the bedrock of the global economy. What if I told you that the very institution that has spent the last decade telling you to stay away from gold and silver, mocking it as a pet rock and a relic of the past, has just admitted they were wrong, not just by a small margin, but by a magnitude that implies the complete destruction of the fiat currency system? And ask yourself this: if the Death Star of the banking world, or the entity most responsible for suppressing the true value of your savings, has suddenly surrendered, what does that mean for the dollars currently sitting in your retirement account? Today, we are going to walk through the anatomy of a financial revolution. We are going to dissect the surrender of Bank of America, the $48 trillion liquidity bomb detonating in China, and the mathematical inevitability of a silver squeeze that could see prices hit targets that sound fantastical to the uninitiated, but are merely statistical certainties to those who have done the math. This is the story of the great capitulation. Let's begin by addressing the red alert and the unlikely messenger behind it. For years, we who understand the value of hard assets have been the resistance. We have been the voices in the wilderness, warning that the debt was unsustainable, that the printing presses were overheating, and that the paper price of precious metals was a lie fabricated by the futures markets. We were called conspiracy theorists. We were told to be quiet, to buy tech stocks, to trust the Federal Reserve, and to look away from the flashing red lights on the dashboard of the global economy. But today, the laughter has stopped. The skepticism has evaporated. Because today, the confirmation of our thesis did not come from a newsletter writer or a YouTube personality. It came from the belly of the beast itself. We need to talk about Bank of America, BofA. For those of you who have followed the metals market for decades, you know that Bank of America is not a friend to the gold and silver investor. Historically, they have been the most bearish, cynical, and aggressive institution when it comes to precious metals. They are the Death Star of the market, a massive gravitational force that has consistently shorted metals and advised their high net worth clients to avoid them like the plague. They have championed the US dollar in the traditional 60-40 stock bond portfolio. So, when Bank of America issues a research note that contradicts everything they have said for the last 20 years, you do not just listen, you take action. On January 6, 2026, the Death Star lowered its shields. In a move that can only be described as a total surrender, BofA issued a red alert to its clients. They looked at the same data we have been screaming about: the debt, the geopolitical fracturing, the supply constraints, and they finally admitted defeat. Let's look at the numbers they put in black and white, because they are staggering. For years, their analysts told you that gold was overvalued at $2,000 an ounce. They said there was no upside. Now, their official target for the average price of gold is $4,138 per ounce. Pause for a moment and consider what a gold price of $4,138 implies. It does not imply a healthy economy. It does not imply a soft landing. A gold price of nearly $5,000 implies a catastrophic loss of confidence in the US dollar. It implies that the purchasing power of the currency you used to buy your home and save for your grandchildren is being halved in real time. But they went even further. The most shocking admission was regarding portfolio allocation. Traditionally, mainstream financial advisors, the kind you might meet at a local branch, would recommend a 0% to 5% allocation to precious metals. They viewed it as a speculative hedge, a tiny insurance policy. In this new report, Bank of America stated that gold and silver should no longer be considered speculative. They stated that precious metals must constitute 20% to 30% of every single portfolio. Think about the magnitude of that shift. To go from 5% to 30% is not an adjustment. It is a panic move. It is a realization that the other 70% of the portfolio, the government bonds, the tech stocks, the municipal funds, is in mortal danger. When the biggest bear on Wall Street tells you to put nearly a third of your wealth into a barbarous relic, they are telling you that the building is on fire and you need to find the exit. I want to pause here for a moment because this is a critical turning point. I want to hear from you in the comments below. Do you trust Bank of America's sudden change of heart? Or do you think they are just trying to position themselves before the crash? Do you believe they are genuinely warning us, or is this just another strategy? Let me know your thoughts. I read every single comment. But if you think the gold call is surprising, wait until you hear about the $309 silver signal. While the gold call is headline grabbing, the true explosive potential, the kicker that proves that banks are trapped, lies in what they admitted about silver. Silver has always been the volatile younger brother of gold. It is the metal of the people, the industrial workhorse, and the asset most heavily manipulated by the paper markets. Bank of America looked at the historical ratios between gold and silver. They looked at the geological reality of how much metal is actually left in the ground. And they finally did the math that the smart money has been terrified of for years. They admitted that silver is coiled to explode. They didn't give a conservative target of 50. They didn't even stop at the old all-time highs of $50 reached in 1980 and 2011. They looked at the inflation-adjusted data and the money supply. Based on the 2011 trading ratios, they projected a target of $135 per ounce. But when they applied the metrics of the 1980 bull market, the last time the world faced a true inflation crisis, they projected a price target of $309 per ounce. $309. Let that number sink in. We are talking about an asset that has been pinned under $30 for years. We are talking about a potential 10x return from the lows. Why would they issue such a shocking number? Why would they put their reputation on the line with a prediction that sounds like hyperbole? They aren't doing it because they like you. They aren't doing it because they want you to get rich. They are doing it because they are trapped. They are looking at the data and seeing a catastrophe coming down the pipe that they can no longer hide. They know that the paper game, the ability to print infinite futures contracts to suppress the price, only works as long as there is some physical metal moving in the background to satisfy delivery demands. But the physical metal is gone. In the same report, they quietly admitted the terrifying reality of the supply side. They acknowledged that global mining production is collapsing. They expect production to be down significantly this year. And it isn't just that the mines are producing less, it is that the cost to get the metal out of the ground is exploding. Energy costs are up. Labor costs are up. Equipment costs are up. The all-in sustaining cost, AISC for miners, has skyrocketed. Bank of America knows that at $25 or even $30 an ounce, the miners cannot survive. Many mines were barely breaking even at those levels, but at $300, the economics work. Bank of America knows that the price must rise to incentivize production, or there will be literally zero silver available for the industrial economy. They are prepositioning themselves. They want to be able to say, "We told you so," when the price goes vertical. They want to be on the right side of history when the squeeze happens. Even though they spent the last decade on the wrong side of the trade, this capitulation is the signal we have been waiting for. In every major bull market, there's a moment where the smart money stops fighting the trend and starts chasing it. That moment is today. When the biggest bear turns into the biggest bull, it means there is no one left to sell. The sellers have left the building. There's only a vacuum above us. This brings us directly to the catalyst of this event, the $48 trillion liquidity bomb. If Bank of America's surrender is the what, then we must understand the why. Why now? Why is the physical market drying up so rapidly that the banks are forced to panic? To understand this, we have to look east. We have to look at the dragon that has just awoken from its slumber and decided to consume every ounce of metal on the periodic table. While Western media is distracted by interest rate fractions, unemployment decimals, and political theater, Beijing has just initiated the single largest monetary event in human history. We are not talking about a stimulus package. We are not talking about an infrastructure bill. We are talking about a liquidity injection so massive that it distorts the very fabric of the global economy. Reports confirm that China has expanded its M2 money supply by 48 trillion yuan. To give you some context, that figure is roughly double the entire M2 money supply of the United States of America. Think back to the inflation we saw in the US after the Federal Reserve printed just $5 or $6 trillion during the pandemic. We saw the price of eggs triple. We saw housing prices explode. We saw the cost of living become unbearable for millions of retirees. Now imagine a monetary bomb nearly 10 times that size detonating in the Asian market. But here's the critical difference, and this is what most Western analysts fail to grasp. When the US prints money, where does it go? It goes into financial assets. It goes into Apple. It goes into Nvidia. It goes into financial derivatives to prop up the banking system. It creates a bubble in paper assets. The Chinese are not doing that. They are not printing 48 trillion to save their real estate developers or to pump the Shanghai stock index. They are printing that money with a singular strategic purpose: to convert worthless paper currency into hard assets before the global fiat system collapses. They are executing the largest wealth transfer in history. They are taking these newly printed yuan and they are deploying them like weaponized capital into the global commodity markets. They are buying oil, they are buying copper, they are buying pork and grain. But most aggressively, they are buying gold and silver. They are essentially saying to the Western world, "We will give you this paper that we just printed out of thin air, and you will give us your physical metal that took billions of years to form and millions of dollars to mine." And the West, in its hubris and stupidity, is taking the deal. The West is selling its gold and silver to China in exchange for fiat currency that is being debased at a rate of 48 trillion a cycle. This is the black hole effect we have warned about. China has become a gravity well for precious metals. This huge injection of liquidity means there is now an unlimited bid in the East. If the price of silver rises to $85, China will buy it. If it rises to $90, China will buy it. They don't care about the price in yuan because they can print infinite yuan. They care about the ounces. They know that whoever ends up with the most ounces when the music stops is the one who gets to write the rules of the new monetary order. So they are sweeping the shelves, they are draining the London vaults, they are draining the Swiss refineries, they are draining the COMEX. And this explains why the premiums are exploding. You see, usually when a government prints this much money, their currency collapses. But the yuan isn't collapsing against the dollar yet. Why? Because they are backing it with the commodities they are buying. They are turning the yuan into a resource-backed currency in real time, while the dollar remains backed by nothing but debt and promises. This 48 trillion wall of money is the force that broke the back of the short sellers. Bank of America saw this M2 number. They ran the simulations. They realized that no amount of paper shorting in New York can stop a 48 trillion buying spree from Beijing. If JP Morgan sells 1 billion ounces of paper to suppress the price, China will just print enough yuan to buy all the physical metal that those paper contracts represent. The shorts are bringing a knife to a nuclear gunfight. Now, we must uncover the trap, specifically the 4.4 billion ounces that the banks are short. We must look at the glass jaw of the Western banking cartel. We have to look at the specific number that is keeping the risk managers at Citi and JP Morgan awake at night, sweating through their sheets. That number is 4.4 billion. According to the latest analysis of the Bank Participation Report and the derivative books of the major swap dealers, the combined net short position of the Western banking system in silver is estimated to be 4.4 billion ounces. Now, big numbers often get lost in the noise. We hear billions and trillions every day in the news. So, let's contextualize what 4.4 billion ounces actually means in the real world. The entire planet Earth, every mine in Mexico, every mine in Peru, every mine in Poland, China, and Russia combined, digs up approximately 800 million ounces of silver per year. That is the limit. That is the hard cap. You cannot print more ore. You cannot speed up geology. 800 million ounces is all we have. So do the division. 4.4 billion divided by 800 million is roughly 5.5. The banks have sold, on paper, 5.5 times the entire annual production of the human race. They are short 550% of the global supply. Think about the insanity of that position. In the stock market, if a hedge fund is short 20% of a company's float, we call it a crowded trade. If they are short 100%, like they were in the GameStop saga, we call it the mother of all short squeezes. But here in silver, they are short 550%. It is a level of leverage and recklessness that has no parallel in financial history. And here's the trap. They sold this silver years ago. They sold it at 18. They sold it at 22. They sold it promising to deliver metal that they do not have, believing that they could always crash the price to buy it back cheaper. But they didn't count on the Chinese liquidity pump. They didn't count on the solar chokehold. And now with the price ripping higher, they are underwater by an astronomical amount. Every single dollar that silver rises costs them billions in mark-to-market losses. If silver goes to the Bank of America target of $309, the losses aren't just painful. They are terminal. They are extinction-level events for these financial institutions. But the money isn't even the biggest problem. The biggest problem is the physicality. A short position is, by definition, a promise to deliver. When you are short, you owe someone metal. In the past, the banks could always settle these debts in cash. They would say to the investor, hey, we don't have the silver, but here's a check for your profit. And the speculators would take the check. But today, the counterparty isn't a speculator. The counterparty is China. The counterparty is the solar industry. The counterparty is the Pentagon for their missile guidance systems. These entities do not want cash. They cannot build a solar panel with a check. They cannot build a Tomahawk missile with a wire transfer. They demand the physical bar. And when they stand for delivery on 4.4 billion ounces, and the vault only has 300 million ounces inside, what happens? The system breaks. It hits a brick wall at 1,000 miles per hour. This is the margin call from hell. It forces the banks into the open market to become buyers. Imagine the panic. The same entities that have suppressed the price for 20 years are suddenly forced to switch sides. They have to scramble to buy back 4.4 billion ounces to cover their naked shorts. But who is going to sell it to them? Are you going to sell it to them? Is China going to sell it to them? No. We are holding. China is buying. So the banks will be bidding against a vacuum. They will bid 85s, no sellers. They will bid 90, no sellers. They will bid $100, still no sellers. This is how you get a vertical price move. This is how you get gaps on the chart where no trades even occur because the price is moving so fast. This is how you get to $309, not in 10 years, but in 10 weeks. It is a mathematical inevitability. You have a fixed supply of 800 million ounces. You have a demand shock from China of 48 trillion yuan. And you have a short covering panic of 4.4 billion ounces. There is simply not enough metal in the crust of the earth to bail out these banks. They have sold the wind, and now they are reaping the whirlwind. This leads us to the most dangerous deception happening right now, the $80 trap and the fake price. This leads us to the most dangerous deception happening right now, because the banks know they are trapped. They know the math better than I do. So what is their strategy? How do they survive this? They have only one play left. They have to trick you into giving them your silver. They have to create a fake price on the screen that looks high enough to tempt you to sell, but is actually a massive discount to reality. We need to talk about the $80 trap. Right now, you might look at your computer screen or your trading app and see silver rallying. You see green candles. You see the price hitting $80 an ounce. And I see the comments online. I see the celebration. People are high-fiving each other, saying, "We made it. We are rich." Friends, stop celebrating. What you're looking at is not the value of silver. What you're looking at is the price of a paper promise on the COMEX Futures Exchange. And I'm here to tell you with absolute certainty that $80 for a physical ounce of silver is trash paper. It is a lie. It is a manipulation. And it is a trap designed to steal your metal before the real move begins. Here is the reality test. Do not trust the chart. Trust the market. Pick up your phone right now. Call your local bullion dealer. Call the big online retailers like Appimex or JM Bullion. Ask them to sell you a 1-ounce American Silver Eagle for $80. Ask them to sell you a 10-ounce bar for $80 an ounce. Do you know what they will tell you? They will laugh at you. They will tell you, "I'm sorry, but we have no inventory at that price." They will tell you that the real price, the price to actually hold the metal in your hand, is $90. It is $95. In some places, for premium coins, it is already over $100. This is the decoupling. This is the moment where the paper market and the physical market snap apart. The banks are using high-frequency trading algorithms to keep the paper price pinned at $80 because that is where they can manage their losses. They want you to look at $80 and think it is a great selling opportunity. They want you to dump your physical stack back into the system so they can scoop it up and cover their 4.4 billion ounce short position. They are fishing for liquidity. They are dangling a worm in front of you, hoping you will bite. But if you sell your physical silver today at the screen price, you are selling a winning lottery ticket for the price of a ham sandwich. You are giving away the only asset that protects you from the 48 trillion inflation tsunami coming out of China. Think about the premiums. In a normal, healthy market, the premium, the extra cost above the spot price that you pay to a dealer, is usually small, maybe $2, maybe $3. But today, we are seeing premiums of $10, $15, even $20 over spot. What does that tell you? It tells you that the spot price is fake. It tells you that the spot price is broken. If the spot price was real, arbitrage traders would buy paper contracts, take delivery, and sell the metal to dealers to close the gap. The fact that they cannot do that, the fact that the gap is staying wide, proves that the COMEX is not delivering metal. It proves that the paper contract is defective. It is like a check that bounces. The paper says $80, but the bank says insufficient funds. So why is Bank of America talking about $309? Because they know that eventually this paper charade has to end. They know that eventually the paper market will shut down or cash settle, and the only price will be the physical price. And when that happens, the price won't slowly drift from 80 to 100. It will re-rate overnight. It will gap up to $150 in a single trading session. This is what happened in the nickel market. This is what happened in the palladium market. When the physical shortage becomes acute, the price becomes vertical. So my warning to you is this. Do not let the green candles on the screen fool you into thinking the squeeze is over. The squeeze hasn't even started. What we are seeing now is just the pregame show. We are seeing the banks trying to shake out the weak hands one last time. They are hoping that you're desperate enough, or bored enough, or short-sighted enough to sell. But you have to have the mindset of a central bank. Does China sell when the price goes up? No, they buy more. Does the Pentagon sell when the price goes up? No. They build smelters to hoard more. So why would you sell? You are holding the collateral of the New World Order. You are holding the battery of the green energy revolution. You are holding the only form of money that has no counterparty risk. And right now, the most powerful institutions in the world, from the People's Bank of China to Bank of America, are fighting a war to get that metal away from you. The $80 trap is their weapon. Do not walk into it. However, even if they wanted to escape, they face the geological cliff, and here is why supply cannot save them. Even if the banks wanted to cover their 4.4 billion ounce short position, even if they printed infinite money to buy the metal, they have run into a problem that no amount of financial engineering can solve. They have run into the supply cliff. In that same report where Bank of America raised their target to $309, they quietly admitted the most terrifying statistic of all. They admitted that global silver mine production is expected to fall by 2% this year. Now, 2% might sound like a small number to you, but in the world of commodities, a 2% contraction in supply during a 20% explosion in demand is not a deficit. It is a famine. It means the shelves are getting emptier every single day. And here is the secret that the mining industry knows, but the Wall Street analysts are just figuring out: price does not create immediate supply. This is the inelasticity trap. The bankers think that if the price of silver goes to $100, the miners will just turn a dial and produce more silver. They think it is like a factory. If you need more iPhones, you just run the assembly line for an extra shift. But a mine is not a factory. You cannot just turn up a mine. If silver hits $100 tomorrow, do you know how much extra silver will come out of the ground next week? 0. It takes 10 years to find, permit, build, and operationalize a new silver mine. 10 years. So if we start building new mines today, which we aren't, due to environmental regulations and capital constraints, the metal won't hit the market until 2036. For the next decade, we are stuck with the supply we have. And the supply we have is collapsing. Why is it collapsing? Because of the easy silver fallacy. For the last 100 years, we have mined all the high-grade silver that was near the surface. We picked the low-hanging fruit. Now we are having to dig deeper, process more rock, and use more energy just to get the same amount of metal. Grade degradation is real. In 2005, a miner might get 15 ounces of silver per ton of rock. Today, they are lucky to get 4 ounces. This means you have to mine 3 times as much rock to get the same ounce of silver. And mining rock requires diesel, it requires electricity, it requires labor. As energy prices rise, the cost to mine silver explodes. Bank of America knows this. They know that at $30 an ounce, half the mines in the world were barely profitable. They know that the only way to keep the lights on is for the price to go to $300. And there is another layer to this geological nightmare. Most silver, nearly 70% of it, is not mined on its own. It is a byproduct. It comes out of the ground when you are mining for lead, zinc, or copper. This means that silver supply is held hostage by the global economy. If we go into a global recession and the demand for lead and zinc drops because construction slows down, miners will shut down those base metal mines. And guess what happens to the silver supply? It disappears. We could be in a situation where the demand for silver is skyrocketing because of solar panels and monetary investment, but the supply is crashing because base metal mines are closing. It is the perfect storm of scarcity, a structural geological deficit that cannot be fixed with money. This is why Bank of America surrendered. They looked at the charts, they looked at the vaults, and then they looked at the mines, and they realized that there is no cavalry coming over the hill. There's no flood of new supply coming to save their short positions. The hole is real, the hole is deep, and the hole is getting wider. This brings us to a critical personal realization: the retirement betrayal and the death of the 60-40 split. We need to pause the macro discussion for a moment and bring this right down to your kitchen table. We need to talk about what Bank of America US admission means for the funds you rely on to pay your electric bill, buy your groceries, and support your lifestyle in these golden years. We need to talk about the silent confiscation of your retirement. For the last 40 years, every financial planner in America has sold you the same product, the 60-40 portfolio. They told you to put 60% of your money in stocks for growth and 40% in government bonds for safety. They told you that bonds were the ballast of your ship, that if stocks crashed, bonds would rise and your capital would be preserved. They called it the risk-free return. But look at what is happening today. The risk-free return has become return-free risk. When Bank of America tells you to increase your allocation to precious metals to 30%, they are quietly admitting that the 40% of your portfolio sitting in bonds is dead. Why? Because the bond market is mathematically broken. Remember what we discussed about China? They aren't just buying gold. They are selling U.S. treasuries. They are dumping the American debt that backs your pension fund. When the largest foreign holder of U.S. debt decides to sell, the value of those bonds crashes. And because inflation is running rampant, the Federal Reserve is forced to keep interest rates high. Here's the trap for the retiree. When interest rates go up, bond prices go down. It is a seesaw. If you're holding a bond that pays 2% interest and the new bonds pay 5%, your old bond is worthless. No one wants it. So the safe part of your portfolio, the part that was supposed to protect you, is now the anchor dragging you to the bottom. This is why you see your 401k balance shrinking even when the stock market looks flat. You're being attacked from both sides. Inflation is eating your purchasing power and the bond crash is eating your principal. Bank of America knows that the pension funds are insolvent. They know that the Social Security Trust Fund is being eroded by this same inflation. They know that the only asset that historically performs well when both stocks and bonds are failing is physical metal. By telling you to move 30% into gold and silver, they are effectively telling you to become your own central bank. They are saying, the system we built for you is failing. You must build your own life raft. But here's the catch. Your fund manager cannot pivot fast enough. A massive pension fund like CalPERS or the New York State Teachers Retirement System cannot just wake up tomorrow and buy $1 billion of physical silver. There isn't enough metal. If they tried, they would send the price to $500 overnight. They are too big to move. But you are not. You have the advantage of agility. You can walk into a coin shop today. You can secure your position before the institutions figure out how to exit their dying bond positions. Do not wait for a letter from your plan administrator telling you they have restructured your benefits. Do not wait for the news anchor to tell you that the bond market has frozen. By then, it will be too late. The 60-40 split is a relic of a low inflation world that no longer exists. In the new world, the world of $309 silver, the only safety is possession. Silver is not just an investment for you anymore. It is the replacement for the bond portion of your portfolio. It is the only asset with no counterparty risk. A bond depends on the government's ability to tax your grandchildren. A stock depends on a company's ability to sell products. But an ounce of silver depends on nothing. It simply is. It is wealth that cannot be inflated, defaulted on, or sanctioned. Secure your retirement by securing the metal. And friends, if you are finding value in this analysis and you want to ensure you stay ahead of the curve as this financial storm unfolds, please do me a favor. Hit that like button and subscribe to the channel. It helps us get this message out to more people who need to hear it, and it ensures you won't miss our next update as this situation develops. So, what is the final verdict? Let's discuss the final marching orders. We have spent our time today dissecting the anatomy of a financial collapse. We have looked at the surrender of Bank of America, the monetary flood from China, the impossible math of the short positions, and the hard reality of the geological cliff. But all the data in the world is useless if you do not have the courage to act on it. The time for debate is over. The time for watching the market is over. The crash is here. And when I say crash, I do not mean the price of silver is going to crash. I mean the system is crashing. The mechanism that has allowed Wall Street to control the price of your labor and your savings for 50 years has finally snapped. The spread we are seeing today, the gap between the 80 paper price and the 100 physical reality, is not just an arbitrage opportunity. It is the death rattle of the fiat currency regime. It is the sound of the dam breaking. And when a dam breaks, the water does not trickle out. It explodes. You have to understand the psychology of what happens next. When those banks finally get the margin call from hell, when they are forced to cover those 4.4 billion ounces, the price will not go up by 10%. It will not go up by 20%. It will go vertical. We are talking about a move of 100% overnight. We are talking about waking up tomorrow morning and seeing silver trading at $150 and then $200 by lunch. This is what happens when a 5,000-year-old asset is repriced to reflect 48 trillion of new money. It is a melt-up. And in a melt-up, the person holding the paper gets wiped out, and the person holding the metal becomes the new bank. So this is my final instruction to you. This is the go order for the resistance. Do not sell. I don't care if the screen says 85 lives. I don't care if it says 90. Do not trade your sovereign wealth for their dying promises. Do not let them trick you into bailing them out. They are drowning, and they are begging you for a life vest. Do not give it to them. Let them drown in their own liquidity. Instead, if you can still find metal, if you can find a dealer who hasn't realized what is happening yet, or a neighbor who is asleep at the wheel, buy it. Buy the premium. Buy the scrap. Buy the junk silver. Clear the shelves. Because the window is closing. We are entering a period where silver will simply become unobtainium. You won't ask, what is the price? You will ask, is there any left? And the answer will be no. Bank of America has given you the target, $309. China has given you the catalyst, 48 trillion. The geology has given you the guarantee, production collapse. The universe is screaming at you to hold the line. We have won the argument, now we must win the war. The Western Front has collapsed. The enemy has capitulated. The road to triple digits is wide open. Do not waver. Do not blink. This is the moment we prepared for. This is the transfer of wealth from those who printed the money to those who held the assets. The alert is red. The target is locked. Go.